Well, as we wait for some more folks to come in, I am very excited to introduce Evan Waggoner, who is the director of SG Credit Partners and also community partner of Natural New York. We truly appreciate their support. Today, we are going to be focused on asset-based lending. So without further ado, Evan, take it away.
Yeah, thanks so much, Adrian, and thanks everybody for joining. Very glad to be here, teaching you about what I've spent better part of the last 10 years doing. So asset-based lending, or ABL, for anybody who saw my LinkedIn post, I did promise to teach you all the acronyms. So ABL is a form of debt financing, probably gaining a lot of momentum over the last kind of couple of years. So ABL as an industry tends to pick up kind of cyclical. So as recession and thoughts of recessions creep into mind, ABL tends to be a little bit more popular. So SG Credit Partners, really quick, we are a family office asset-based lender, and we're primarily focused on high growth consumer brands. It's a little bit different from traditional ABL, which I'll spend a little bit of time going through both. I would say, or my former colleagues at the bank would say, it's not your grandma's ABL. But today, I think it's really important to note that ABL has evolved from its roots, 30, 40 years ago, has really evolved into having many different nuances. And obviously, private credit is also a big topic these days. So there's a lot of individuals, institutions, et cetera, who are participating in the ABL market. So without further ado, I'm going to jump into just a quick overview on some of the different types of debt. And I'm not going to cover every single type because there's there's just too many. I'm going to focus on kind of some of the main ones that I believe this audience will see and potentially be using, whether now or in the future. So the first is a cash flow loan. And before I actually get into that, so this is an income statement, balance sheet, and cash flow statement from a customer prospect that we've looked at recently. Have changed some of the numbers a little bit so as not to give anything away, but I think it's a very very good example and very indicative, easy to kind of go through different types of debt here. So without further ado, the very first type of debt that you may run across or know about is a cash flow based loan. So it's right in the name. Cash flow is based on the ultimate bottom line, the health of a company. So typically this is done by banks, and it's done in the form of the revolving line of credit, the RLOC, or the term loan, TL. So a lot of commercial banks, corporate banks will underwrite, the ultimately, like I said, the credit health of the company, but they're underwriting to a metric of either net income or the operating profit, otherwise known as EBITDA. The next one that I think that this group will see, and these are really sort of based on the income statement for now, but is revenue based or merchant cash advance. So the merchant cash advance you may also hear is MCA. So this is where a company may not have the bottom line to support a cash flow based loan, but has the top line to support it. We've seen this pick up a lot more frequently recently, where it's also used as bridge financing to some event in the future. But typically these are shorter duration tenors and can be utilized very successfully when the company's top line supports the debt need. So moving on to what is kind of quasi income statement, especially in our world, would be a venture debt facility. So venture debt facilities are typically underwritten either alongside or shortly after, potentially even before an equity raise. And the underwriting is really done on the valuation that the equity raise commands. So this is less about the income statement and less about the balance sheet itself, although you can think of both as derivatives of the valuation. But at the end of the day, the venture debt facility is typically done alongside an equity raise and may not be available to companies who don't have that investor support, or at least the recent investor support. So moving down to the balance sheet, probably the most common form of balance sheet financing, and what we're going to spend most of our time talking about today, is asset-based lending. So again, ABL can come in the form of a revolving line of credit or a term loan, but it's typically focused on specific assets or specific accounts. So accounts receivable and inventory financing. We'll get into some of the nuances here, but there's a lot of different ways for asset-based lenders to lend on those accounts. And then I've circled PP&E here as well, because what you'll find is that even without, you may be able to kind of stack some of these debt financing options. You may be able to have a cash flow term loan on the business, on the EBITDA or the net income, but then you may also be able to have equipment financing off on the side, which is a form of asset-based lending. So ABL comes in many shapes and sizes, and one of the other forms of ABL that we won't spend too much time on is called factoring or purchase order financing. So factoring is primarily done on the accounts receivable themselves. I think I'm missing a red circle there, and purchase order financing also done on the future receivables. But we've also seen some of the fintechs lately find creative solutions to sort of extend accounts payable. So I've circled that here because they typically fall under similar structures. But as I said, most of today we're going to spend focused on asset-based lending, and in particular on the revolving line of credit side, which is focused on the working capital, the AR, and the inventory. And I'm not a PowerPoint whiz, but hopefully you guys will appreciate some of the fun animations and transitions that I've created here. This was a good day yesterday. So the next thing I want to talk about is kind of putting this into perspective, the life cycle of debt. And I, again, won't get too deep into this, but just thinking of companies, especially in this network, kind of having 4 different stages of life. One would be the launch stage, where conceptually you've got it nailed down, you've got your business plan. Maybe you've already started selling. Maybe if you're a food or beverage company, maybe you're selling at a farmer's market and you're trying to land your first store, or maybe you're in a few stores and you're trying to land Whole Foods or a bigger account. So debt options are not created equal, and they're not available to everybody. A lot of different scenarios, but I'll try to keep it as general as I can. So at launch, the first option is typically the founder and friends and family. And that's obviously, I mean, everybody who's ever raised money before has likely seen or gone through this stage. Typically, people are just looking for a proof of concept. And once you get past the launch stage, you're probably not going to turn to that circle for funding anymore. But also at the launch stage, you may be able to get a local or community bank, or even SBA, Small Business Association, to provide funding. And sometimes that may be due to relationship or historical experience with that lender. Other times it may just be the specific circumstance. The lender is looking to deploy funds, and you happen to walk in at the right time. It may also be that you've worked with them before, so obviously there's a relationship, but you have a lending history with them, and they feel very comfortable providing that capital to you. Additionally, some of the bank or SBA options may require a personal guarantee. So at the launch stage, I would sort of keep that in mind and be prepared that a personal guarantee may be required. Additionally, at the launch stage, we have seen both the revenue-based slash merchant cash advance, as well as factoring slash purchase order financing. We've seen lenders, kind of, I think, approach more companies in this stage of life, particularly the fintechs or the financial technology companies. So the fintechs are different from kind of just say a bank lender, in the sense that it's typically something that you can go online to their website and fill out a form, and potentially be approved for credit right on the spot. And it may be that they're underwriting to a number of different factors, but the fact remains that we've actually seen this kind of conceptually gain a lot of steam in the last, say, 5 years. So the next stage would be the early stage. This is where, let's say that you're sort of past the farmers markets and you've landed into, Whole Foods, and you're trying to grow the business, but you're not quite profitable. This is if you're raising capital, equity capital, you're probably kind of talking to some venture capitalists or private equity, maybe even an angel investor who's writing a larger check. But this is where you're going to start to attract other debt options that were not available to you at the launch stage. Again, I mean, the local and community bank option for the bank slash SBA, that's probably going to be with you for a while. But if you see in the revenue based slash merchant cash advance and the factoring slash purchase order financing, you'll see some institutions start to come in. So there are funds and non-bank lenders who will do this, and it really depends, I would say, on a number of different things as to who will give you the best rate or who will give you the best structure. So it's a good exercise if you're in this stage to shop around, to talk to a few people. May be a pain in the neck to go through that process because you may not have the bandwidth. But educating yourself on the different options and starting to build some of those relationships, even if you know that it's not going to be a fit today, but it may be a fit for that lender in a year or 2 years. You have to sort of, as a founder and as an operator, you have to understand that lenders have mandates and parameters as well. So that definitely worth kind of exploring. And obviously, I think the asset-based loan becomes an option here for companies that are in this early stage where they're growing but not yet profitable. Typically, this would only be from a non-bank, but also I would say that the venture debt option becomes available as well. And that may be from just a venture capital investor on their own, or it may be from a fund. But just good to know that there's different options, and you as an owner operator have to decide what's best for you. And again, we'll kind of get through these a little bit more, but obviously each one has different structure, different costs, different repayment, etc. So the next stage is the growth stage. So this is kind of thinking of this more so as, let's say, again, you're a food and beverage brand, and you've gotten national into Whole Foods. Maybe you're in Walmart or Target. getting into a handful of grocery stores, say 5,000 doors or so. But you're still not where you're not at your end goal yet. So the business is, I did not use the word growing. I used the word scaling, thinking of the growth as, kind of a major hurdle, to get from, 2 million to 10 million of revenue or so. And then once you're at 10 million, you've started to pick up some real momentum. And now it's just about how do we execute? How do we, land the next 1,000 doors or whatever that is. But to do so, you're still not profitable. And it's okay if you are. I mean, there's going to be companies that are profitable from launch, which may have different options from others who are not. But typically, what we see in the growth stage is companies that are scaling but not yet profitable. So, kind of going through the options, very similar to the previous, but want to call out a couple of different things here, primarily just on the last two options. On the asset-based lenders, in the growth stage, I think you're more likely to find bank lenders providing term sheets or at least having very real conversations. And on the venture side, you're likely to get a lot of interest from the institutional investors. And then at the very end of this, we have the dream, right? This is what everybody's working towards. You've scaled and you're profitable. So here, I think options kind of become limitless, and you can really, kind of get what you want from the market. And I would say that the revenue base slash merchant cash advance option, we see most at this stage being used as a bridge. So company is going through a cash crunch or something, and needs an aggressive little slice of capital for 6 months, and that revenue based option could be a good fit. But more importantly, kind of in the asset based world, you'll have the bank and the non-bank option. I put bank here because bank first, because that's probably the most likely path forward if you're going to stay in asset based lending. But having the non-bank there is important, because what you'll find at this stage is that while a bank may give you, a term sheet that's cheaper pricing, non-bank obviously more expensive, but they may give you a more aggressive term sheet. So effectively giving you more money or under a looser structure. Again, at the end of the day, it's all about options. And then the very end, the cash flow, this will be available from a commercial bank. There are also non-banks who do cash flow lending. But I think at that point, if you're considering bank debt, then that's probably the direction that you will end up going. So want to just quickly highlight kind of what is asset-based lending, and we'll walk through an example here. But going back to our exhibit, income statement, balance sheet, and cash flow statement. So at ABL is effectively lending on the balance sheet. It's primarily targeted at working capital and the specific assets like equipment or real estate. But at the end of the day, it's very different from a traditional revolving line of credit. It's very different from a term loan. The whole purpose of ABL is to manage your working capital and to use the loan facility as a tool to manage your cash flow. So I think, like, thinking about how is this different from the other types of facilities, obviously just sort of revolving line of credit versus a term loan. Some Probably half of the different debt options that I mentioned don't offer a revolving line of credit. But the whole purpose of ABL, and I think generally taking a step back to think about the purpose of any of these types of debt, is working capital, and that should be your primary focus when you're pursuing an ABL facility. And then the other thing to think about here is repayment. So how do you plan on repaying? I mean, any debt that gets taken out, has to have some sort of notion of repayment. The venture debt facility that we mentioned earlier may be one of the few that has more of a conversion option. But at the end of the day, really shouldn't be thinking about any sort of debt without a repayment plan. Um, so as we get into just walking through a different example, this is actually just one of my favorite companies to use as an example. And for those of you who know me, I'm a huge fan of The Office. So the Michael Scott Paper Company. This is excuse me. Thinking about one second. Thinking about this company in a very simplistic way, and I don't believe I need to explain kind of what they do, but thinking about this company in a very excuse me, in a okay, sorry. Thinking about this company in a very simplistic way, we can one second. I'm sorry. We can see that um, the company is healthy. They're profitable. They have typical industry margins, and it seems like they have a healthy balance sheet as well, with $1.5 million of net equity. And I want to kind of explain the context of the simplistic nature of this example with one supplier and one customer. So the one supplier is Hammermill, which Michael Scott himself landed at a conference in Philadelphia, and Staples. So those two customers in this example, you can sort of back into the metrics via the income statement and the balance sheet. But we're thinking of Hammermill being a shorter term net 15-day supplier, and Staples having net 30 days, and the inventory on the balance sheet being carried in line with the Staples with net 30-day terms. So thinking forward to what does next year look like, want to use the example of Staples commits to buying more, so we have a 10% increase in revenue, but they're going to pay slower. So they're going to pay in 45 days instead of 30 days. Now that increase in volume allows Michael Scott Paper Company to go back to Hammermill and negotiate a price reduction. So they get a 1 point pickup on gross margin. Doesn't sound like a lot. It's huge for the Michael Scott Paper Company. But unfortunately, Hammermill says we'll give you this if you pay us in 10 days instead of 15. And then there's some additional costs associated with the increase in sales. So what looks to be a very healthy year in 2022, although margins have compressed a little bit, we're going to tell a very different story under the ABL scenario. And that story is all in the cash flow statement. So what we can see here is that although they were still profitable, bottom line increased, or sorry, the bottom line was still positive, and net equity increased, as did the balance sheet. We see that the working capital was strained, and they primarily financed that growth via an asset-based facility. So just kind of high level, this is the whole purpose of asset-based lending, in that the company's profitable. They could have potentially had a bank line of credit that was underwritten to their profitability. They could have used a revenue-based lender, although they may not have been able to take out what looks like $628,000 at the end of 2022. They may not have been able to take out that much debt with a revenue-based lender, and they certainly didn't have an equity raise or anything coming in. So the asset-based line of credit in this example really kind of illustrates how you can use ABL to manage working capital and still grow the business effectively. And going back to what we were kind of talking about, what ABL is, one thing that we get a lot, and I'm sure this community is asking itself, is why don't you just use cash? Why don't you use cash instead of debt, and you can be in full control and you don't have to manage it. There's no reporting or monitoring or covenants or anything to worry about. And it's a great question that I would pose, right back to the founders, where it really becomes a management decision as to whether or not they want to use cash. It's sort of like if you have cash in the bank and you still have a credit card and you're paying things on your credit card. Why wouldn't you just use your debit card? Everybody's different. Everybody has a different philosophy on how to manage their cash. As an asset-based lender, I would say that the ABL does sort of force you to manage things much tighter, manage your balance sheet and working capital much tighter than it would if you were just using your cash. And additionally, for those brands that are raising equity, as we see here with the $5 million raise in 2021 and a follow-on $1 million raise in 2023. I would say that at some level, investors are tolerant of equity dollars going in to buy inventory and to sort of finance that working capital. But at some point in the future, if you continue raising capital, you will come across investors who do not want their equity dollars to go in to buy inventory. So that's definitely something to consider. And one other thing I'll mention on the kind of just what ABL is it's a different there's so many different options inside of ABL and considering the lender universe. So ABL itself, very high level, is a multi-trillion-dollar market. And I would say core asset-based lending, somewhere in the hundreds of billions. But when you think about factoring and equipment financing, et cetera. When you speak to anybody who says that they're an asset-based lender, it's good to understand kind of what version of ABL, what language they're speaking. Okay, so we're going to stick with this income statement, balance sheet, and cash flow statement, and just kind of talk through how does ABL work. So from a very high level, ABL is a pledge of collateral. So we're highlighting the accounts receivable and the inventory, and again, that's what we'll spend the most time on: machinery and equipment, as well as real estate. Kind of already talked about these from a high level, but additionally, ABL includes intellectual property. Now you'll notice that there's no highlight on the balance sheet here, and somebody's probably going to ping me afterwards and say, "Hey, this belongs in goodwill or intangibles," and it does if you buy a company and it's on the balance sheet. But otherwise, intellectual property is another one of these things that's really hard to define and place a number on, although inherently you'll get valuations, et cetera, that you can point to. But point being that asset-based lenders really prefer to have concrete, tangible assets that they can lend on. That being said, I mentioned that SG, we are kind of a newer version of asset-based lending where we will consider intellectual property as an asset that we can provide additional leverage on. So something to keep in mind as you are exploring the world of ABL. Is this a lender that only lends on accounts receivable and inventory? There are some lenders who only lend on inventory or only lend on AR. Does this lender only do equipment financing, or do they do everything that's listed here? On the structure, so ABL is typically either the revolving line of credit or the term loan. The term loan is, I would be shocked to hear of anybody offering a term loan on an accounts receivable or an inventory borrowing base. Those are almost exclusively reserved for the revolving line of credit. But the term loan would be on specific machinery, equipment, for instance, assets. Whereas the revolving line of credit will have a borrowing base of the margined accounts receivable and inventory. And in our next example, we're actually going to walk through what does a borrowing base look like, how do we construct it, etc. And then one other thing we're going to talk through after this kind of are the nuts and bolts of ABL. So this will be borrowing and account structure, covenants, reporting, monitoring, etc. And we're going to go back to Michael Scott Paper Company to kind of go through ABL and let's say that you are the Michael Scott Paper Company and you're coming to me as a lender. So I'm going to show you all kind of how we as asset-based lenders would sort of approach this and think about it. And very different from others. For an asset-based loan, you can't go to a website and fill out a form and then get approved for a line of credit. Typically underwriting, like the initial underwriting process would be, a week or a couple of weeks. And this would be the lender each lender has their own diligence request, but primarily you can get a lot of information, or at least in terms of making a credit decision, lender can get a lot of information just out of sort of the recent financial statements. But we're going to highlight three different reports that we as a lender typically ask for as part of these financial statements as well. So one would be an accounts receivable aging. So the AR that you see on the balance sheet is not always the AR that a lender is willing to lend on. So for those of you who enjoy The Office, I hope you'll see some of the Easter eggs that I've left in here. But this AR aging in particular, you'll see that and it's aged by the due date, but most of the AR is current, which is great. This is what every lender wants to see. Any of the AR that's aged starts to become a little bit more concerning, and it's typically grouped into 30-day buckets, just like your NetSuite or something your ERP will spit out. So what we've got here are primarily everything is either current or within 1 to 30 days past due. This tells us as a lender how good are you at collecting, and how are your customers treating you as one of their vendors. But I will say that most lenders do not have a tolerance to lend to provide leverage on any of the invoices that are significantly past due. And typically greater than 30 days past due is the threshold. So we can look at this aging here and just see that any of the AR that's 31 or more days past due would be counted as ineligible. So we can go ahead and sort of cut 9% off of the total borrowing base for the AR. Additionally, looking at the top 5 customers and trying to understand if there's any concentrations. This is not completely standard across the board, but most lenders will implement a concentration threshold of 25%. So any customer that counts as more than 25% of your total AR, that incremental value above 25% is typically ineligible. So here we would effectively be cutting another 11% or so off of the accounts receivable. But otherwise, there's several other different categories of ineligibles, which we'll discuss in a minute. But high level, this is sort of what the asset-based lender goes through when they're thinking about accounts receivable. Moving on to inventory. So this particular inventory perpetual shows the majority of the inventory is finished goods. This is the favorite category of the lender to lend on for inventory. Finished goods are easily saleable, and you probably have some really good insight as to on a SKU level basis, what is selling and what we can sell it for. At the end of the day, keep in mind, asset-based lenders are underwriting to a liquidation. They're underwriting to a worst case scenario. If the company goes bankrupt and we have to sell all of this inventory and collect the AR, how much do we think we're going to get back? So you'll typically will not find that asset-based lenders don't have a tolerance to lend on things like WIP or sorry, work in progress process or packaging, but may have tolerance to lend on raw materials. And that really depends on what the raw materials are. And a distributor like Michael Scott Paper Company typically doesn't hold a lot of raw materials. Perhaps in this case, their manufacturing operation, Coman, for instance, they hold or they purchase some of the raw materials, and the co-man is working through them. Most lenders will consider raw materials on a case by case basis, but it's not guaranteed. And typically, you'll find that the advance rates on raw materials are lower than on finished goods. As far as locations go, I will say that locations all being local, there's a whole process, especially if you use a 3PL for a lender to actually secure on that physical inventory. But when inventory is primarily in one or two locations, that is best. That will get you the strongest advance rates. When it's spread out a bunch of different locations, especially if they're smaller values relative to the entire balance of inventory, typically the lender will prefer not to lend on those locations. So in this particular scenario, we're probably not going to lend on the inventory at Nashua and Utica, although clearly neither of those branches are as important as Scranton. And then the last thing would be accounts payable. And we're also asking for and looking at an AP aging. So this may seem a little counterintuitive, right? Because we're not lending on AP, we're lending on the accounts receivable and inventory. What we want to make sure is that you as a business are paying your bills, and ultimately that you're paying your bills such that the vendors, especially when you have a large concentration, i.e., with Hammermill, that these vendors are going to continue shipping. Because if you decide, hey, we're going to stretch our vendors because we need to preserve cash, the vendor may say, perfect, we don't want you as a customer anyways, go find somebody else, right? And that's a major disruption in the business that lenders who are risk averse obviously want to avoid. In this particular scenario, we've got seemingly, pretty decent AP aging. Most lenders will either cut the threshold off at current or 30 days past due. And obviously there's, case by case basis considerations that could be made, but typically lenders will say anything that's more than 30 days past due, we don't like that. We want to reserve against it and sort of motivate you as a borrower to pay those bills and keep all of your vendors current, such that potential business interruption can be avoided. So taking all three of these into account, what does this look like in a borrowing base? So this is my nice little attempt at building a borrowing base. But what we've sort of deciphered is on the ineligible front, we see that AR, we've taken roughly 20%, nice round number, roughly 20% ineligible for a net amount of AR that we can lend against of 586. And then we're lending 85 cents on that accounts receivable to get to 498 total potential borrowings. So before I get too deep into it, just knowing that the ineligibles are typically determined by a field exam, which is where a CPA comes out to the company and kind of goes through journal entries and books and records and does the reconciliations to ensure that they're that the standards, the accounting standards and practices that the company are using are in line with what the lender likes to see, but also to identify certain ineligibles almost in a forensic manner, just to ensure that all the bases of risk are covered. Um, on the ineligible side for raw materials and finished goods, sometimes these are a little bit more intuitive. For instance, the 5% of the finished goods, which we sort of identified at Nashua and Utica, those are probably ineligible. But the 10% of raw materials could be a number of different things. For a food and beverage company, it may be something that's aged or expired or spoiled, or it may be raw materials that were ordered in bulk that have been opened. And for a lender, probably have no recovery value if you have to sell an open tote of some sort of food product. Um, so that's kind of high level. First thing that gets removed in the borrowing base from the gross amounts. And then as I kind of got into what the field exam does to help identify the ineligibles, but it's also important to note that inventory is typically appraised. So that is the NOLV, or net orderly liquidation value, here in the second to last column of the borrowing base. So the net orderly liquidation value is when an appraiser comes and values all the inventory and says, if we have to snap our fingers and sell it at whatever point in time, here's what we think we get back from it. And not every lender will require an appraisal. Not every lender will lend on the NOLV. But a lot of times for lenders, it's great to have a second set of eyes, particularly with some of the large firms that are experts in certain industries and with certain inventory. So what we've got here are the advance rates. And as I mentioned earlier, raw materials likely to have as high of an advance rate as finished goods. But what you will find is that every lender is completely different. So some lenders, these are sort of industry standard advance rates, but some lenders may not have the tolerance to go to 50% on the raw materials. Others may not lend on it at all. If the raw materials are a commodity, just like a huge tote of honey, for instance, that can easily be sold back out into the market, and you have a really good idea of what the market price is, you may find a higher advance rate for something like that. As I said, finished goods, you know exactly what it is. You know what your margins are. You have really good detail on a SKU level as to what's being sold, who's buying it, etc. So you're likely going to find a deeper advance rate there. I've included these sort of exhibit NOLVs just for high level Michael Scott Paper Company purposes, but typically the inventory is advanced at the lesser of the advance rate here. So for finished goods, the lesser of 65 cents or 85 cents of the NOLV. And that's to provide some additional cushion. Again, lenders are inherently risk averse. So the next thing I want to get into is caps and reserves. So anytime you ever see the headline of $1 million revolving line of credit in an asset-based facility, that $1 million is the maximum that you can borrow, but it's always limited to the lesser of that $1 million or the borrowing base itself. And in this particular case, it is 832,000 is the borrowing base, and the line cap, or the maximum amount that can be borrowed, is 1 million. So you always take the lesser of, but how ABL generally works is, we have this borrowing base today. As a borrower, you're either updating this borrowing base on a weekly basis, on a bi-weekly basis, or on a monthly basis. So that number is going to change pretty frequently. And that $1 million just gives you enough room to grow from 832 into 1 million without having to do an amendment and reopen any documentation or redo the facility. Most lenders will provide kind of a simple, easy process to increase that $1 million. So It's great to have it right up front because a lot of the fees and pricing depend on getting that number closest to wherever the best number is. But at the end of the day, most lenders have the ability to easily, increase. So one other thing after we kind of get to our gross availability is reserves. This case, I've just included the AP reserve. So this would be AP that's 31 days past due or greater. So 42,000 coming off of the borrowing base. So the total net borrowings for Michael Scott Paper Company here is $790,000. And then we subtract the revolver outstandings. This is from the balance sheet that we had on the previous slide. So this particular company has $162,000 of excess availability. So the 162,000. This is a very important number for lenders, and I've included the last bullet here for liquidity because after sort of getting through the assets, the balance sheet, P&L, understanding what does a borrowing base look like and what does excess availability look like, this is essentially when a lender determines whether or not it's a good fit for them, whether or not they have the tolerance to take on any risk whatsoever. So if this number were negative, for instance, then that would mean that there's not enough borrowing capacity to even finance this company, and which is not a end of the road. It's just to say that the lender has to consider taking on more risk, incremental risk. And how do we do that? Maybe we increase the advance rates. Maybe we revisit the ineligibles and we say, okay, Staples were taking away 9% of their AR up here because they were above our 25% concentration cap. But we feel really comfortable with Staples and their credit profile and their risk. There's a long history of Michael Scott and Staples working together. So we're going to give Staples a higher concentration cap. And that may increase borrowing availability and capacity, ultimately increasing liquidity, which again, at the end of the day, is the most important thing to any asset-based lender. And liquidity is calculated by adding your excess availability here, which is 162, to the cash that was on the balance sheet, and then comparing that to the burn rate. And thankfully, fortunately for Michael Scott Paper Company, they were not burning cash. So they were profitable and cash flow positive, although they were cash flow negative after including working capital. But at the end of the day, for companies that are burning cash, especially in the VC-backed world, where you've taken on capital and the mandate is to grow, and you have extra cushion to burn cash in order to grow, that an asset-based lender will look and say, okay, well, we've got X amount of cash, we have X amount of borrowing capacity. Does that cover enough of the burn, the current burn or the projected burn? And that's what they're underwriting to. And most lenders prefer to see enough liquidity to cover at least 12 months of a historical burn, but understanding, especially in sort of in the growth world, that things are changing so frequently. You're typically sort of one big customer, you're one Costco order away from the business being very different. So a lot of lenders have the ability to underwrite, very kind of in their own unique and customized approach, i.e., SG Credit Partners, and how we specifically work with early stage and high growth consumer brands who are in these positions. But when that number is so small, for instance, if you have 3 months of liquidity calculated as excess availability plus cash, when you have enough availability that only covers 3 months of your last 12 months burn, and the go forward plan is to burn just as much, but you may have to raise capital in the future, that's a tough call for the lender because they say, well, if we have to raise capital in the future, how quickly can that be done? Do we have to go to market? Do we have to hire an investment bank? Are the existing investors going to step up and do this? And that's where the relationship lending aspect really comes into play, versus something like a revenue based facility, where it's just sort of more transactional, and you're drawing it based off of whatever the computer algorithm spits out. So asset-based lending is very unique in that way. And I'm running a little behind on time here, so I'm going to speed up. Um, the typical account structure for borrowing, most of you probably have something that looks like this: just a single operating account. Customers are paying into it, and vendors, you're paying your vendors or payroll out of your operating account. And if you have a line of credit, then you would borrow from the operating account or pay it from the operating account. But in asset-based lending, what you typically have is a separate, rather than an operating account where funds are commingled, your customers would pay into a separate collections account, and then that collections account sweeps to the line of credit. And then as you need to borrow to pay your vendors or to pay your payroll, then you would borrow directly from the line of credit. Just to note that this is industry standard. Every asset-based lender will require something like this. Sometimes that collection account is a lockbox rather than an independent bank account. And there's multiple nuances depending on who the lender is, who the bank is, and what the preferred structure is. But at the end of the day, this is a pretty simplistic view. And I'll say that some of the stronger credit profiles in the asset-based world have the ability to sort of move their collection accounts back into their operating account. So at the end of the day, it kind of gets you to the same place, but having the separation of the commingled funds is one of the foundations of asset-based lending. So getting into the structuring, want to just say that there's two, when we think about the revolving line of credit, there's really kind of two schools of thought, and that would be a committed revolving line of credit versus a demand note. So the fully committed line of credit is typically, they're both sort of used for the same thing, but the fully committed is a long-term relationship. And the best way to describe it is, if you as a company are going, to go bankrupt, and you as an operator, that that's going to happen, it's a risk. The fully committed line of credit spells out all of the scenarios that require the lender to continue lending to you in that downside scenario. The demand note, however, or an uncommitted line of credit, is actually the opposite. So at the first sign of trouble, the lender has the ability to pull out of the credit facility, to call the loan, to put you in default, whatever it may be, versus the committed line of credit has a much longer kind of lifespan, and in doing so is really there for the full ride. But at the end of the day, they're really used for the same thing: working capital growth, CapEx, and general corporate purposes. I've included term loan here just because there's a couple of differences as we go through the list. But obviously the term loan is typically based on the specific assets or the CapEx. We get into the amortization. So the revolving line of credit typically does not have any amortization whatsoever, whereas the term loan, again, based on the asset, that the underlying collateral. But I will say, on the revolvers for seasonal businesses, it's not uncommon for a lender to say, okay, at the end of the season, especially if you're selling snow blowers, for instance, at the end of winter, we want to see the line paid down to zero, and we'll restart it from zero every single year. In any case, the ABL facility is going to require a borrowing base, and sort of monthly, annual financials. There may be requirements for CPA reviewed financials or audits. Kind of depends on case by case basis. The committed facility will have more monitoring uh, features. So the field exam is probably going to be a little bit uh, more intense, I'll say, versus an uncommitted facility or a demand note, where it may be a little bit lighter. And in the committed facility, you're more likely to have an appraisal. I put it as a slash and in parentheses. It's not always required, but you're definitely more likely to have an inventory appraisal, for instance, in a committed versus an uncommitted. And then on the term loan, if there's a term loan on equipment, it's very likely that that equipment will be appraised prior to. In the thinking about covenants, the primary covenants for asset-based lenders are financial covenants and liquidity covenants. This is very typical in a committed facility. They can be, financial covenant could be minimum EBITDA, it could be a minimum revenue, or a debt service covenant, or a fixed charge coverage ratio. But the liquidity is really kind of the baseline. It's just to ensure that at all times there's enough liquidity in the business. Don't want the company to run out and then everybody start thinking about what to do next. But I will say too, in the demand note or the uncommitted facility, covenants are typically much lighter, and sometimes there's no covenants whatsoever. That's just because the lender has the ability, whenever they start feeling uncomfortable, they have the ability to call the loan and move on. And as you'd expect, documentation's a little bit more fulsome in the committed facility. But if you're doing a term loan, it's typically just a sort of a quick add-on to whatever either committed or uncommitted revolver. And then for the rates fees, I'm sure this is everybody's question. It depends. Unfortunately, I can't give you a great answer. In the non-bank world, we see rates from prime 0 or maybe even prime -1 at some of the big, billion-dollar funds with the large credit facilities, all the way to prime 10 or prime 15 for a very risky credit profile that the lender feels like there's significantly high risk of liquidation. But I will also note that in a committed versus an uncommitted facility, committed facility is typically more expensive versus the uncommitted, and that again goes back to the inherent risk, where the committed facility, the lender is committing to stay with the borrower through thick and thin, whereas the uncommitted, the lender has the option to exit at their discretion. So as we wrap up here, I want to do a sanity check and just make sure that people are still with me. This is probably one of my favorite quotes from Michael Scott. And just to wrap this up, I want to just cover kind of who is doing this and who is this for. So obviously, Michael Scott Paper Company, we've gone through. Shameless plug here for SG. So these are some of the great customers that we are currently or have worked with in the past. A couple of good New York names here. But also want to say that the ABL market is wide, and I've highlighted here a couple of the largest deals from 2023 that were announced. Some brands you may know of or not know of, but Topgolf Callaway has a nearly $2 billion ABL facility. So a lot of that obviously you can think of as the Topgolf facilities. But they're, the brands themselves also have a working capital need. So they have a $525 million revolving line of credit. Rivian here has a $1.5 billion ABL led by JP Morgan Chase. Neiman Marcus has a $900 million ABL facility. You can imagine that all of those stores have a significant need to finance their working capital. And I'm not as familiar with this company, but I believe somebody can fact check me on this. I believe this is the largest ABL, true asset-based revolving line of credit last year, and it may be one of the largest in the market. But a $3 billion facility. This one was led by Capital One. So I think we're right at an hour. I apologize for blabbing all the way through. And I think Adrian may have some questions, but for anybody who wants to chat further, please give me a call or shoot me an email or ping me on LinkedIn. I'm always available. And this was sort of the intro. There's definitely another more in-depth version that we can do in a one-on-one or maybe later in the year. But yeah, thank you guys very much. Apologize, I don't know what's going on with my throat, but really appreciate the time. Glad to be able to do this. And yeah, Adrian, I'll turn it back over to you.
Okay, great. Thank you so much, Evan. Truly appreciate all your insights here. And for everyone on the line, just so you know, we will be sharing the presentation and Evan's contact materials with you if you want to follow up after. I also just want to give a quick plug to Naturally New York that we are actually going to be at the Beyond Skew Track 4 Pitch Showcase event tomorrow night. So if you're in New York or nearby and want to attend, it's in Union Square at Project Farmhouse, really cool venue. So it's free. Come check it out from 5 to 9. I just dropped the RSVP link there. If you would like to, we only had a couple questions. So do you want to tackle those real quick or do you have to
Yeah,
go?
sure.
Yeah. Okay. So the first one came from Sam Herster. Can you touch on average rates today or over time on the types of debt categories provided on slide 2? Well, that
Yes,
was
happy to do it. Let me go all the way back to the beginning there. A lot of animations. This is a good time.
I also love the Dunder Mifflin references. Michael Scott favorite. Yeah.
So, cash flow financing from a bank is typically the cheapest or some of the cheapest that you can get. The market is generally I don't know if people are familiar with SOFR, which is the secured overnight financing rate. It replaced LIBOR, I think like 18 months ago or so, or prime. So we typically lend plus or minus prime, but a lot of the bank market will lend on SOFR. Either way, they're both floating rates. But banks, you'll typically find SOFR, which is updated daily. Prime is updated as rates change. But the bank market is typically like SOFR plus, 2 to maybe 4%, give or take. And asset-based lending in the bank market is generally about the same. It might be a touch more expensive than cash flow lending, but it really depends on the structure. So if you're used to prime or understand what prime is, that would be kind of a prime -2, prime -1, maybe prime 0. That's generally where the bank market is. The non-bank market you can typically think of as being a few points more expensive than a bank on the low end. So some of the biggest funds will be able to, their cost of capital is different. They may be able to fund closer to a bank. But I would expect the non-bank market to be anywhere from like a prime 3 to prime 8 or so. And the prime rate right now is 8.5%. So I realize I should have probably started with that. So that's anywhere from like kind of 10 to 15 or maybe 20% as a total yield. But ideally, fingers crossed, rates are going to go down soon, and all the floating rate debt will go down with it. The revenue based, and I just covered a couple of categories there. The revenue based or merchant cash advance is typically one of the more expensive rates, and that may or may not be fixed. You really almost, if you're looking at any sort of proposal in this category, you really need to spend some time and model out the costs, because at the end of the day, we typically find that these are more expensive than something like asset-based lending or even cash flow lending. But I would guess that revenue base can range anywhere from 10%, including prime on the low end, to say 25 or 30%, maybe even more on the high end, and annualized rate, et cetera. But just trying to compare apples to apples here. The venture debt side, well, let me just jump to factoring or in purchase order financing. Or I already covered ABL, generally kind of in the same bucket as cash flow, a little bit more expensive. The factoring or purchase order financing, um, this is sort of the same as the revenue based, where it's typically more expensive than asset based, but it really depends, because if the factoring facility is one customer, accounts receivable from Walmart, and the factor feels very comfortable there, then it may actually be cheaper. And factoring can be used, very effectively to manage working capital as well. And then the last option here, on venture debt. So venture debt is typically more friendly from think about it like a cash pay type of structure. So your cash outlay is I would say minimal, at least compared to other types of debt. There may be a PIK feature, where the interest accrues and you're not paying it, but it accrues kind of on the accrued interest already. So that can increase exponentially over time. And then again, a lot of the venture debt either takes a warrant up front or has the ability to convert some or all of that debt into equity in the future. So thinking about like, what does that debt cost today versus what is the equity cost in the future? That's something that every individual has to make. But I would say venture debt, typically targeting a sort of 15 to 25% yield on any given year.
Thanks. Thank you so much, Evan. And thank you
Mhm.
everyone again for joining us today. We're a bit over time, but always great to have such an engaging conversation. People interested in participating. So we'll see you at the next one.
Great.
Have a great day.